the class comments in NS. So in our last class, we talked about the introduction to hydrocarbon tax. Can you hear me? Please confirm if you can hear me. Please confirm if you can hear me, please.
Yes, we can.
Okay, thank you. All right. So we spoke about the administrative procedure for hydrocarbon tax. We spoke about the host community development. We spoke about the type of licenses a company in the oil and gas could have. We went straight to the fiscal aspects where we talked about that a company that is into hydrocarbon will be subject to a dual tax regime where the taxpayer is expected to file returns both in uh, file returns both in what's it called, both in hydrocarbon tax and also for companies income tax. So we spoke about that in the last class, and I remember we stopped at non-allowable expenses in our last class. So, and I told you that the allowable expenses and non-allowable expenses are peculiar to this kind of business. For example, one of the non-allowable expenses that we spoke about in our last class is bad debts, interest on loan, research and development costs, that is indirect cost to the business, are not an allowable deduction under hydrocarbon tax. However, I told you that interest on loan, bad debts, are allowable under companies income tax. So these are some peculiarity that you need to note when you see expenses that are not liable. So we spoke about the tax rates where we said if a company is in shallow water, shallow waters, or company that has converted from the old regime to the new regime, the company will pay 30% as company income as hydrocarbon tax. We now also said that if the company is a marginal field, that is a company that has a very low production profile, such a company would be accessible to tax at the rate of 15% for hydrocarbon. We spoke about all that in our last class. So today, uh, we also spoke about basis of assessment, where I told you the basis of assessments of an upstream company is on actual year basis. Downstream and midstream is on preceding year basis. And midstream is mostly gas, and downstream is the marketing of petroleum products. Midstream talks about gas and the marketing of gas. Meanwhile, downstream is only talking about the sales of petroleum products. Now, we talked about the accounting period, where we said an accounting period is, we're going to be looking at it in three perspectives. We said where the company is just commencing operation, or where the company has just commenced the production of bulk crude oil for the first time. So when we talk about that, we now said that the company will be assessed to tax as a commencing company. And thereby, it's going to be from the day the company make the disposal of chargeable oil to the end of the company's accounting, to the end of the accounting year end. Okay, so we said from the date of commencement to the end of the accounting year, and just like you know, a petroleum company is always preparing its tax on actual year basis. Now, if it is on actual year basis, you know that an actual year basis is a base period that must have started and ended within the tax year. The base period must have started and ended within what? The tax year. Therefore, if that is the case, then we talk about that if a company is commencing, that means it has to be from January or from the date they commence sales or disposal of chargeable oil to the end of the year. That is for commencement. Now, a company that is not just commencing operation, okay, that is a company that is ongoing concern. So the company will be assessed with tax from the date of commencement from the first day of the year to the end of the year. That is, it's an accounting period that will run for 1 year, and it's going to be from January to December for a going concern company that is company that has been existing for so long. Meanwhile, for a company that is shutting down the operation, that is company that is going to be ceasing, so it's going to be from January to the end of the business life. So those are the things that we spoke about in the last class. We have spoken about liable expenses, and we're currently discussing non-liable expenses before we left the other day. So we have said penalty for flare of natural gas is not allowed. We spoke about disbursement or expenses not being money wholly reasonably or exclusively incurred for the purpose of petroleum operations will not be allowed. Head office costs will not be allowed. Shared costs will not be allowed. Research and development costs or any other indirect production costs will not be allowed. Depreciation, that is normal, will not be allowed. We talked about expenditure incurred to purchase information with regards to the petroleum deposits other than acquisition of geological, geophysical, and geochemical data and information will not be allowed. And so on and so forth. We have so many. And one important aspect of this is the fact that interest on borrowing, finance and bank charges, arbitration costs, litigation costs, bad debt, all those will not be allowed according to hydrocarbon tax principle. So I expect that by now every one of us has read this and we understand it. So let's move on to accessible profits. How do you ascertain accessible profits under hydrocarbon tax? Your accessible profit will be ascertained after you have deducted from your adjusted profits any loss incurred for the year. So adjusted profit will be what? Accessible profit will be your adjusted profit less loss relief. Now, how do you treat loss in petroleum operations? Under hydrocarbon tax, a company has rights to defer its utilization of its losses against the profit for a period of 5 years. However, the consent of IFRS must be sought. Okay, so you can actually defer the deduction of your loss. You can defer the deduction of your loss, but must be informed about this deferment, and this has to be done within 5 months. You have to inform FIRS. Apart from that, the amount of any loss incurred by the company during the previous accounting period for an existing period shall be allowable and deducted against the adjusted profit. So what we are trying to say here is that you have a loss in a prior year that you're unable to utilize, you can carry forward to the current year and utilize it. That's what we are trying to say. And for a new company, the amount of any loss incurred in the first period shall be allowable. Now, any deferral will be deducted in the subsequent years, on the subsequent year rather, unless you also make an election that, okay, don't remove this loss against my profits. Okay, and additionally, the loss incurred in the prior year has priority over the one that you incur in the coming year. So if you incur a loss last year, and this year the company also has loss, when it comes to relieving the loss against profits, the loss that you're going to relieve against profits will be the first one that you will take, will be the previous one that you have incurred before the current one. So that is what we are talking about. Do you have any question? Okay. In the absence of none, we move to chargeable profits. I hope you are noting all this. They are very important for our computation. Chargeable profits will be your accessible profit less capital allowance and also less production allowance and any other annual allowances. Now, before now, we used to have what we call investment allowance. Investment allowance has been taken out from hydrocarbon. Under petroleum profit tax, investment allowance still exists. And just like I said the other time, Petroleum Profit Tax Act, some companies are still using it, okay? So it is very important that we know how to go about that. But for this year exam, you might not need to bother yourself about petroleum profit tax. Rather, you focus on your hydrocarbon tax. So as I was saying, I said Your chargeable profit will be ascertained by you deducting from your accessible profit your capital allowance, your production allowance. Okay. Now, in your company income tax, there is nothing like production allowance. And you remember, in ascertaining your total profit, you would always say your total profit will be your your adjusted profit less accessible profit, sorry, less loss relief, and at the same time less capital allowance to get your company income tax. Sorry, to get your total profit. That is what we usually do when it comes to um, total profit for company income tax. However, chargeable profit is different because in ascertaining your chargeable profit here, you are considering your capital allowance and you're also considering your production allowance. Now let's look at what we do when it comes to capital allowance for an hydrocarbon company. How do you get the capital allowance and how do you compute the capital allowance? Now, it is very important that, when we talk about capital allowance the last time, when we met, we said capital allowance is allowance granted to a taxpayer that has incurred qualifying capital expenditure and that has incurred qualifying capital expenditure and the assets that you are the qualifying capital expenditure that you have incurred will be in use at the end of the basis period. So invariably, we are saying that for an asset to qualify as for capital allowance purpose, the assets must the person making the claim must have done some things. Number one, we said the company must have incurred expenditure. Number two, ownership must not be in doubt. When we say ownership must not be in doubt, what we're trying to say here is that the owner of the business has relevant interest in the assets. And we also said that the assets must be in use at the end of the business period. We talked about the purpose of the assets. The purpose must be for uh, in this case, it must be for petroleum operations. Initially, we have said for the purpose of the business. Yes, our business here is petroleum operation. So for the purpose of petroleum operation, that is why you have incurred this expenditure. And for you incurring the expenditure, the taxpayer would be allowed under the tax law to claim relief. Will be allowed under the tax law to claim relief. So that is what we are talking about. So we have said capital allowance granted to a taxpayer that have incurred qualifying capital expenditure at the end of the basis period and put the asset into production use at the end of the basis period. Okay. Now, having said all these characteristics, now for the purpose of capital allowance under company's income tax, you remember the acts in the company income tax, I think schedule 4. Yes, schedule 4 talks about capital allowance under company income tax. Now, for that purpose, you remember we have two types of capital allowance. Now, we have the initial allowance and the annual allowance. So in this regard, there is nothing like initial allowance under hydrocarbon tax. Rather, the only allowance that we have here is annual allowance. Now, what are the types of qualifying capital expenditure we could have under uh, hydrocarbon tax? We have, this is restricted, sort of. We have expenditure incurred on plants, machinery, or features. Expenditure incurred on pipeline and storage tank. Expenditure incurred on construction of building structure or works of permanent nature. Expenditure incurred on tangible and intangible expenditure other than tangible and intangible drilling under section 263. The next one is the acquisition of rights. You remember we talked about licenses. That is what we are talking about here. So that acquisition of rights over petroleum deposits is capitalized and will be amortized over a specific period of time. Now, I will say that where an asset is partly used for the purpose of petroleum operation, the portion that is partly used will be allowable for deduction. The one that is partly used for the purpose of petroleum operation would only be the one that will be allowable, while others will not be allowable by the tax law, by FIRS. Now, just like I've said the other time, I told you specifically that we only have annual allowance instead of the initial allowance that we always talk about. There is no initial allowance here, we only have annual allowance. Now, for the purpose of the annual allowance rates, the rate of annual allowance under hydrocarbon tax is 20%. It's 20% and it's constant. And when I say a rate is 20%, that means when you're calculating the number of years the assets we use, or the number of years we're going to calculate annual allowance on the assets, is going to be how many years? 5 years. It should be 5 years. So that is it. So basically, we are saying it's going to be 5 years that any asset acquired by any company would be used. You can only use it for 5 years. That's what we are saying. You can use it for only 5 years. And after which, it will be written off. Now, in the last 5 years, in the last year of the usage of the assets, because I've always told you that you need to always retain, you need to always retain 10 naira under company income tax. Here, your retention is 1% of the cost. That means in the last year of use, the asset would be we calculate the annual allowance in the last year of use to be 19% rather than the 20%. So the last year of use will be 19%, while the first 4 years will be what? 20%. So that you can have 1% retention that we talked about. And this is a table that explains that. In the first year of use, you calculate 20%, second year, 23rd, 24th, 20. But in the fifth year of use, because we had believed that the assets should not be completely written off, then we retain 1%. Now, unlike companies income tax, where when you want to dispose your assets, you don't need to inform anybody. Here, you cannot dispose your assets without informing the commission. That 1%, if you want to dispose it, you must inform the commission about it before you are going to be allowed to dispose such. So that is that. The same thing is exploration expenditure and first to appraisal wells. For exploration expenditure, you remember in our last slide we said first exploration drilling will be allowable. We now said first to appraisal well will also be allowable. Now, the ones that are not allowable, what happens to it? It's going to constitute capital expenditure. Okay? That is, if we drill like 3 wells, the first 2 are expense, are liable. The other ones will be capitalized. And in the process of capitalizing is you also use the procedure you use in calculating your annual allowance to do that. So let's look at an illustration. The following information was extracted from the account of Ramon Oil Limited for the year ended 31st December 2023. You are given. Note something. Year of acquisition. What year are we? I expect everyone to respond now. What year are we?
2023.
Good. And you remember, we said that the company under hydrocarbon tax will be assessed to tax on what basis?
Current year
I'm
basis.
asking you a question. Actual year basis. Speak like a tax person. Actual year basis, right? Now, if it is on actual year basis, that means 2023 will be our year of assessments. Am I correct?
Yes.
Okay. No problem. Yeah, thank you, Debbie. So, having said this, the next thing we need to do, we have been given the assets and we have been given the year of acquisition. The asset that we acquired in 2019, in 2023, how many years would the asset have been used? How many years would they have used, rather?
Five years.
Good. 5 years. By implication, what does that mean?
Means it has been completely used, like since access is for 5 years.
So what would you do? What percentage are you going to use? That's what I'm trying to ask.
Okay, we compute the first 4 years will be 20%, the last year will be 19%.
Thank you, Alero. Correct, girl. Yes. I don't know, maybe you have gotten the information you need, Elvis. During the week, you reached out to me that I should explain reconstituted company. Have you been able to get your information around that? Elvis.
Hello, sir. Good morning, sir.
Morning, Elvis.
Yes, sir. I have checked the past questions.
Okay. And you are good.
Yes, sir. Thank you, sir.
All right, thanks. So we said in 2019, this company had acquired an asset. So in year 2023, when I'm going to be calculating my annual allowance on this asset, I'm going to use what percentage? 19%. Okay? Because the examiner said you are required to calculate annual allowance for 2023 year of assessment, right? Sorry, yes, that's what they said. In company that, this one, that means 2019 1, 2022, 2021 3, 2022 4, and 2023 fifth year. In the fifth year, this guy will be 19%. Are you with me? The next one. The one we acquired in 2020, right? How many years would that asset have been used before 2023? How many years? 2020, 21, 22, 23, 4 years. That means we use 20% for this, isn't it? Same for 2022, same for 2023. So let's go to the computation. You understand why we use 19%? Because this asset that we acquired in 2019, it has gotten to the 5th year of use in 2019. Okay. So you calculate it, and this is our answer. Let's look at the other assets, the other question. ABC Limited first made a sales of crude oil, chargeable oil rather, on 1st January 2018 under the program of continuous production and sales. As at 1st January 2023, the company acquired qualifying plant expenditure for 50 million. Between 1st of February 2023 and 31st December 2023, additional expenditure was incurred on plants, machinery, and features amounted to 60 million. You are required to determine the residue of qualifying capital expenditure of the company after 2027 year of assessment. Now, you remember that when we are doing our capital allowance, one thing that I always told you is we need to always identify the relevant basis period or related basis period, knowing fully well that we have always said any asset you acquired within a basis period will be introduced in that basis period, right? Irrespective of when the asset was acquired. You are not, by implication, it means you are not going to be prorating the qualifying capital expenditure when you are calculating the annual allowance. This is not depreciation. So look at this one that was acquired 1st of February. Some would have said 11/12 multiplied by because this asset was acquired within the basis period, we will give it a full annual allowance. The only situation where you prorate your capital allowance is where the company is just commencing operation. Okay? So that is that. If you are there, I am there with you.
That means you're going to prorate this $50,000. I mean, oh sorry, this 60,000.
Hold on, guys. We are not prorating it. That's not what I said. We are not prorating it. Just hold on. I want to make a call. So, as I was saying, you are not going to prorate it because the basis period Because the basis period would, the related basis period would have been, let me write it for you. The base period would have been this date. Can you see my handwriting? So sorry. So the related base period would have been 1/1/2023 to 31st/12/2023. Now, any asset you acquire within this period will fall within these dates. So even if you like acquire an asset on 1/12/2023, you will still calculate your full annual allowance on it. So in this case, this asset was acquired on the 30th, on the 1st of February 2023. Abi? That means you are going to introduce in 2023. So you are not prorating it. So let's go. So that means the total acquisition we have in 2023, they first bought one in 1st of January, they bought the second one within this period, within the basis period. So all the assets will be added together. So making 110. So 110,000 annual allowance will be what percentage? In the first year, 20,000, 20%. So 20% of this, you have this. Residual to be carried forward, you have this. 2024, annual allowance will be constant on the costs. It will always be on the costs. So 20% of the costs will be 22,000, right? The next one, you remove it again from the residual value. The next one, annual allowance, constant, 20% of the costs. You have that. You have that. In 2026, you have 44 million as the residue here. Remove 22,000 from it, or 22 million. You have this. Now, in 2027, what you are doing is, this is the last year of use. I am going to calculate 19% of this cost, and I will have this. 1% retention will be this. So this is my 1% of that cost. Do you have any question?
The 1% is on the cost of the asset, not on the
Everything is
annual.
on the cost. Everything is on the cost.
Okay.
All the annual allowance we have been calculating, they are on the cost. Do you understand me?
Yes, I do.
Good. So, having said that, there could be a situation where the company also dispose an asset. So when the company dispose an asset, it is either the company has what we call the balancing allowance or balancing charge. How does balancing allowance arise? We said in our previous class, it is going to be when your sales proceed is less than the tax now value at disposal, balancing allowance will arise. We also said, how does balancing charge arise? Balancing charge will arise in a situation where the sales proceed exceed the tax now value at disposal. Balancing charge will arise. Okay? So that is that. Do you have any question? So that is what we mean by that. So it's only on disposal. So I said, what is the meaning of disposal in the context of PIA? We said disposal would mean when the relevant interest is sold. When the relevant interest is sold, that means there is a disposal of the qualifying capital expenditure. The next one, when the concession has ended. That is, the license you are given has ended. The next one is when the leasehold interest comes to an end. The next one is when the structure is destroyed, or when the structure ceases to be used for petroleum operations. So that is that. Now, we also said what are the treatments of asset acquired prior to the date of commencement. Any asset acquired prior to the date of commencement, we have talked about that before. We said it shall be put into production use at the date of commencement. Obi, we've spoken about that. Now, when you dispose assets prior to the commencement of business, it will be any profit you make on it shall be subject to capital gains tax. Meanwhile, when there is loss on it, the loss shall not be allowed in the context of capital expenditure. Now, another area that I want you to also focus on is on production allowance. Examiner has always given what the value of production allowance is. They've always given it. So you might not need to calculate it in the exam. But how do you calculate production allowance? If any examiner is going to test this part, I'll believe the examiner is kind of very wicked, because these things are very, very, it's too much for someone to be cramming. But anyway, that is what is in the act. We are going to teach it. Now, for production allowance, you remember I told you we used to have what we call investment allowance in the old acts. There used to be investment allowance where we talked about when a company incur qualifying capital expenditure in a location that is 100 meters of water depth, 200 meters of water depth, and beyond 200 meters of water depth, there were incentives that government granted onto them. Now, incentives. But government has now looked at it that is not enough to drive the economy. And you understand what I'm saying, that is not enough to drive the economy. Because what we are looking at is not only you investing in the economy, we are also looking at you producing, so that when you produce, we have enough resources. Okay, so that when you produce, we have enough resources to talk about. But unfortunately, even the production in Nigeria of today are being stolen by a lot of people. But that is a case for another day. So we are now saying that we are going to be looking at different locations, and whatever you produce will determine your production allowance that we're going to give, because production allowance is like an incentive. It's an incentive rather that is given to the taxpayer for producing more. Do you understand? So it's an incentive. It's an incentive. So the first one is for a conversion contract. That is, you have moved from from PPT to PIA. That means you have been in business before now, so no problem. So we are saying your production allowance will be the lower of 2.5%, 2.5 per barrel, and 20% of fiscal oil price is the lower of the two. We are going to be seeing how to do the calculation as we move on. So the next one, for onshore area, production allowance will be lower of $8 per barrel and 20% of fiscal oil price, up to a cumulative maximum production of 50 million barrels from commencement of production. and the lower of $4 per barrel and 20% of physical oil price thereafter. This is what we are saying. Anything you produce between 0 to 50 million, the allowance that you're going to be getting will be $8 per barrel or $8 per barrel or 20% of the physical price of that barrel sold, whichever is lower. Okay. And again, if your production has now exceeded 50 million, then it is going to be every excess, $4 per barrel or 20% of the physical price of those excess. Then you calculate the what is it called? The production allowance. For shallow waters, that threshold moved to 100 million barrels. And for deep water, the threshold moved to 500 million, the same parameter. The same parameter. So let's look at this example. Let's look at this example. Pillar Oil Upstream Petroleum Company Limited was established several years ago, and the following data for crude oil production for the year ended 31st December 2023 is provided in the schedule below. The first one, we're told prior year cumulative production 50 million, 53 million. Current year 7.5 million. Total cumulative 60 million 500 barrels. Shallow waters 90 million. The next one for current year 35.75 million barrels. Cumulatively, we have 125.75 million barrels. Prior cumulative period 900 million for deep offshore, so for the 7.2, and total we have 97.2 million. So the examiner said it should be noted that the physical oil price advised by NUPRC is $125 per barrel. The company disposed all crude oil produced in the current year at the physical oil price as advised by the commission. You are required compute the value of the crude oil sold for 2023 year of assessments. That means they want to compute the value of the crude oil sold. How do you compute the value of the crude oil sold? They told us for current year. So that will just take this value, multiply by all this value. That will give you the value of the crude oil sold in the current year. Any question on that? Any question on that? Okay. We'll move on to the next one. They now also said you should calculate the what? The production allowance for 2023 year of assessment. So in computing that, this assumption here is that the company had not claimed production allowance before now. So that is the assumption I have used. So you remember the act says for onshore lower or 50 million barrels at $8 and fiscal price at 20%, multiplied by 20%. So we calculate that. We have the lower of the two. You remember the total barrel of this guy is 60 million 500, right? So the first 50 million, we are going to use lower of 20% of fiscal price per barrel and $8 per barrel, lower of the two. So the lower of this is $400 million. They get this. And you now remember that is more than 50 million. So you remember we said any excess will be at what? $4 or fiscal price multiplied by 20%. So $4 of the barrel. So you have this and this for the excess for fiscal price. We have 42 million. Now, this 42 million, if you add it together, you have this. So this is the total allowance that the guy will claim. So the assumption here again is that this company had not claimed allowance before. The same thing for this one. The second one is the shallow waters. You remember the threshold for shallow water is first 100 million. Anything above the 100 million, we use $4 and 20% of the fiscal price. So the first thing we do is to take the 400 million at $8 per barrel. This at 2 point at the same 1.2125 multiplied by 20%. Take the lower of the two. This is the allowance you are going to get. The same thing for this. Now the excess, the total production for that year, cumulatively, we have this. We do that. So the same thing is applicable for the other one because you will remember the cumulative, the threshold for that one is 500 million barrels. So, and that is what we have. Now, if you have any question on this, ask. Is there any question? Okay, if there is no question, just give me 1 minute. Okay, so let's go ahead. The next one that is very important, all these steps that we are discussing, they are going to be useful for our computation of hydrocarbon tax. That's why I'm taking it step by step. So don't look at it as that I'm bothering you. I know how it is. It used to be boring, but I know that we need to consider it. Now, the next one, the next introduction to the act is a cost-profit ratio. Cost-profit ratio. Now, for cost-profit ratio, the tax act is trying to cap the allowable deduction to 65% of the gross revenue. In this regard, the tax authority is trying to ensure that the company pays tax, even where there is a lot of costs that would have made them not to pay more tax. Okay, so the deductible cost before computing hydrocarbon tax shall be capped at 65% of the revenue as measuring points. This includes the following: all expenses and capital allowance. The expenses stated above shall exclude. We are saying to get our comparison now, because we are saying that you're going to compare your 65%, you cap it as 5%, and compare with allowable expenses and capital allowance. Now, in doing that, we are saying the allowable expenses we are talking about here shall exclude the following, rather. Shall exclude the following. Number one, rents incurred in pursuance of licenses will be excluded. Royalty will be excluded. Contribution to any fund, scheme, or arrangement approved by the commission will be excluded. And this contribution could be to the host community remediation fund and Niger Delta Commission and any other similar contribution. And production allowance is not needed for our CPR ratio. Now let's look at the example of CPR. How do we compute the CPR?
Why is production allowance excluded since it's a replacement of investment allowance?
So for the purpose of computing that, the act specifically say we should not put it as part of the consideration.
So that is a reprieve.
So
It's a reprieve for operators then.
Yes. So this is what I am saying. So in computing our cost profit ratio, this is what we will do. We will say cost profit ratio is, you want to know your revenue, calculate the 65% of your revenue, and deduct all this. So it's going to be lower of the two, rather. It's going to be lower of your 65% and this. So you remember we said your total expenses, add capital allowance, less all this one, because we said they are not supposed to be allowable. So we're now saying your allowable OPEX for the year shall be lower of these two. Shall be this, lower of this, and this. It shall not be more than 65% of your revenue. Now, if it is now more than 65% of your revenue, the balance will be carried forward to the subsequent year. So that is that.
The carry forward, is it indefinite?
Yes, in that carrying forward, the act does not state the number of years. Do you understand? The act does not state the number of years for which it will be carried forward. Okay. So that is that. Royalty is another key area, but I'm not going to bore you with that. Examiner will not test computation of royalty. But examiner could ask you theory on that royalty. Now, royalty is paid in two forms. Royalty is paid in price and on production. It's paid on price and on production. Royalty is paid on price and is paid on production. Now, if, for example, a company fails to remit the royalty after 30 days from the due date, then the commission will subject the taxpayer to a penalty at the prevailing interest rate. Apart from that, we also have some penalties that the taxpayer will pay. So we said, if you refuse to pay your royalty within 2 months after the month in which it is due, then a sum of 10% of the amounts due shall be added to your royalty. Apart from that, in the case of foreign currency transaction, we will use LIBOR rates to charge you. If it is Naira transaction, we will use NIBOR rates. And for every year, every day in which this failure continues, 30 million naira, 10 million naira for the first day. And for every subsequent one, you have 2 million in which that you are going to pay the liability, the penalty. So what we are saying here is that the first penalty is 10% of the outstanding. Second penalty is in addition to the first one, if it is foreign transaction, we are going to charge you LIBOR rates plus 10% at the prevailing market price. If it is Nigerian transaction, we'll charge you NIBOR plus 10%. Now, apart from all these that we have stated, in the first day that thing became due, the liability became due, we charge you 10 million naira in the first day. And for every subsequent days in which the failure continues, 2 million naira. So nobody would want to fail to pay their tax liabilities and when due. So that is that. So the next one is company's income tax. For company's income tax, it is going to be assessed, the company will be assessed to tax based on the principle of company income tax that we know, and some peculiarity that has been added by hydrocarbon tax. So for this purpose, to administer hydrocarbon tax and company income tax, you must file returns. So that means company will file 2 types of returns. An upstream company or company in oil and gas file 2 types of return. How many returns? 2 types. Number one is hydrocarbon tax return. Number 2 returns, company and company's income tax that you are filing. You are filing annual returns and estimated returns. Your annual returns must be filed within the accounting period. Within the current accounting period for last accounting period. So That means if I am filing my annual returns for 2023, I must file it on or before the 1st May 2024. Meanwhile, for the current year, when I'm going to file my returns, I must file it not later than February 28th of the current year for current year returns. So you are filing two returns, annual returns for prior year and current returns for the current year, estimated return. We call it estimated returns. So, and your annual return must be filed within 5 months of the following year. Meanwhile, your estimated returns must be filed within 2 months of the current year. Do you understand? Firstly, I said we are filing two returns, hydrocarbon tax and company's income tax returns. So let's go. What are the procedures for filing returns? Examiner usually asks this. The procedure for filing hydrocarbon tax return and company income tax return under this section, under this act, is not different. It's the same. So on a yearly basis, petroleum companies are expected to file returns of their estimated tax for the year on or before February 28th of that year. That is, you file an estimate, you compute once you have done your budget, based on that your budget, you compute your estimated returns. So you compute your estimated returns and...
Excuse me, just to clarify, these 2 months means that they are filing estimated returns 10 months in advance.
Yes.
10 months before the end of the financial year.
Yes.
Okay.
For the current year, yes.
For the current year. Why the other one is post, which is the after the year end.
Yes. So the prior year, let's start from estimated. You must file your estimated returns within 2 months after the accounting year end. These estimated returns will go all the way to the 12th return. That is, so the estimated returns that you have filed, just listen, will be due for payments. You have to pay tax on that estimate. And within 1 month after you have submitted your estimate, you must pay your first installment, because under hydrocarbon tax, you must pay installments. So first installment is due on or before 31st March of this following month. You have filed it within 2 months, February. So on or before 31st March, you must you must pay your first installment. The second installment will come 30th April. Abi, 3rd, 31st May, and so on, till it gets to the 12th installment. Peradventure, during the year, you now revise your estimates. Maybe you have now understood that the market is different, market is acting differently. You now readjusted your estimates, maybe upward or downward. Then, in doing such, you will now say the total amount I have paid, the total estimated returns, amount I have paid, and the number of months remaining to get the new return. So what we are trying to say here is that if, for example, you have said you're going to pay tax of estimated that you're going to pay maybe 50 million, or let's say 120 million. So you will first divide the 120 million by 12 to get the instrumental payments. So the first one is 1 million. Abi? The second one will be 1 million. The third one will be 1 million. Let's now assume that in the third year, you now change your estimates to, let's say, 150 million. You have paid 3 million before this period. So you have paid, let's say 15 million rather. You have paid 3 million before now. You now say 15 million, which is the new estimate, minus what I have paid before now, which is 3 million. I will have 12 million. How many months is left? 9 months. I will now divide that 12 million by 9 months. I'll continue to use that new basis as my new estimate. At the end of the day, by the time you get to the 12th installment, now that 12th installment would be by February. Abi, it will be by February. Let's see it. It will be by February. You can see. So in December of the current year, you are paying the last installment in February of the following year. Are you listening? You are paying the 12th installment at the end of the following year. At this time, you have not filed. So you are now going to do your audited financial statements. Once you do your audited financial statement and it has been signed, everybody has signed it, you will now do your annual returns on the audited financial statements. Your annual returns must be filed on or before 31st May of the following year. Do you understand me? Now, in you filing your annual returns, you will now see that you will now know the actual tax that you're supposed to pay, because the ones that you have been paying is based on estimates. Now you have now seen your reports, you have seen everything, so it's going to be based on what you are supposed to pay. Now you are supposed to pay, let's say you are supposed to pay 20 million, but based on the estimate, you have paid 15 million. The difference between the 20 million and the 15 million is what we call final installments or 13th installments, which must be paid on or before 31st May. Sorry, must be paid immediately after 31st May, because you have now done your assessment, you have known the tax that you are supposed to pay, you now pay the difference to the tax authority. Do you understand me? So that means the first estimate you filed is your the first return you file is your estimated returns. The second you file is annual returns. Do you understand me? Now, what are the contents of the annual returns? All the financial statements, your computation of advisable profit, loss, and your chargeable profit, your schedule showing your total production allowance for the year, your schedule also showing your capital allowance, asset acquired, your residue, value of disposal, all those things must show it. Again, statement showing amount that you have already paid. Statement showing amount already paid must also be included in your what's it called? In your contents. The next one is self-assessment form to be attested to by principal officer of the company. And the next one is the evidence of final tax paid. That is the final installment. The evidence, we want to see the evidence that you have made the payments. We want to see it. So that is that. For estimated returns, the only difference between this is that you are going to be including estimates. Unlike the other one that you are including what we call what we are saying actual. Here you are referring to estimates. So what is the penalty for failure to file your estimated returns? To file your estimated returns, what is the penalty if you fail to file your estimated return? Number one, you are going to be paying 10 million on the first day, and every other day that the failure continues, you will be paying 2 million. And also any other sum that the federal government say you will pay it. Okay, so that is that. That is that. Now the next one is the request for additional information request by the Federal Inland Revenue Service. They have right to request for additional information. And this information must be submitted within 21 days. If you fail to do that, you are going to be penalized. Now let's look at this illustration. I will stop the class after the illustration. Mirror Petroleum Company Limited submitted its first estimated returns to Federal Inland Revenue Service on 27th February 2023 with tax payable of 60 million. What did I tell you? Now this guy is submitting a first estimate and the tax payable is 60 million. So the first thing you do, we said for the due date of this guy will be when? The due date will be March 23. I mean March 2023. On or before 31st March 2023. Why? Because I told you you file your estimate on or before February, right? Now the first payment on that will be what? 31st March. So you are paying on that. So you divide it by 12. So you continue. Now, then I told you in July, this guy filed another estimate. So in that July, you have to recalculate the what's it called? The returns. So now he filed 84 million. Now, before now, this guy had paid 1, 2, 3, 4. He has paid for 4 months. So the new estimate now is 84. So I'll say 84 minus 20 divided by 12 minus 4. That means 8 months is left. So I'll divide the balance by 8 months. That's what I did here. So you get 8 million. They told us again in November, this guy had changed his estimates. So when we go to November, we'll do the same thing. In November, how many months have we paid before now? We have paid for 1, 2, 3, 4, 5, 6, 7, 8. So it means 4 months. And this guy changed his estimate. So how much have we paid? We will add everything that we have paid up to this moment together. We will now subtract from that 90 million to get the new estimate and divide by the number of months remaining. So that's what we did here. This one. So we got 9.5. So the 9.5 will be to the end of the S. Now, we're now told that we should compute the tax payable we are told. Now, they now said if the final returns show that tax payable is supposed to be what? 113.65. Determine the taxing installments. What do we do? He has paid 90 million before now. The balance when filing its returns, he filed 113.65. So the difference will be what? Will be the taxes installments. So what he's supposed to pay is this. He has paid this. The difference will be the taxes installments. So this is what the examiner is requesting that we do. Do you have any question? Do you have any question? Okay, in the absence of no question, we meet again in the next class for our computation. Good day to you.
Thank you, sir.
You're welcome.